Here with Philip Lane, live at the ECB forum in Sintra. He's the governor of the Central Bank of Ireland. Thanks so much for your time. Appreciate you joining us. Good morning. Listen, I want to start with Larry Summers' speech last night. I found it fascinating and also a little bit concerning that he thinks governments and central banks around the world in developed markets are not ready for another recession if it comes. Do you agree with that take on the readiness of central banks around the world?
Well, what Larry was talking about last night, and which was really the topic of this whole conference, is where we are in the world is a world where inflation is low. We, I think, all agree, and he gave a good presentation last night on it, that if you like, the natural rate of interest, the rate of interest when the world is at full employment, is a lot lower now than it used to be for demographic reasons, technological reasons. So in that scenario where, if you like, normal interest rates may be quite low, come to a recession, what do you do? But I think what Larry didn't focus on last night, and what we would focus on as central bankers, is interest rate policy is just one of the tools. That here in Europe, we've just been through this big QE exercise, as have other central banks. And the range of tools that central banks can use to maintain its inflation target, even during a slowdown, is wide. So it is a challenge for central banks. It's a challenge about what kind of instruments are appropriate in a low inflation world. So he diagnoses, in common with all of us, this issue. The question is, how do we respond? But I don't think the answer is to say central banks just sit on their hands and say we can't do anything. The answer is that we will use our wide-ranging toolbox to provide the conditions needed in those circumstances.
I was thinking about that too, because one of the things he was warning about was that, if you haven't raised rates enough, then maybe you don't have the ammunition to deal with the next downturn. I immediately thought of the quantitative easing program, but is it still useful? Do you think the QE program, for example, that the ECB has put into effect is still useful at the end of such a long period of bond purchases?
So there's no doubt that a lot of the effect of QE is through, as you say, the accumulated stock of purchases. And if you like, this is a reason why even after this year, even after we expect to conclude the purchase program by the end of the year, the stock of bonds that we've bought will continue to provide easing so long as we maintain that stock. But what is also true is that quantitative easing also has a signalling effect. So one thing last week was, if you like, we gear shifted in signalling from using the monthly purchases to using forward guidance on interest rates to help the market understand that these low rates will remain for a considerable period through next summer. So I think what we're all talking about is how to execute monetary policy in this world. But let me slightly correct you there. I didn't hear him say central banks should preemptively raise rates in order, if you like, to keep the powder dry for the next recession.
Not at all. That's a question a lot of people, I think, were asking this morning.
But I think what's correct is that is not the way to think about it. Is we have to keep monetary policy accommodated until we hit the target. It is not the case that you would preemptively raise rates now in order to lower them in the future. Better to help the recovery by having an accommodated strategy so long as it's needed. And then if future problems arise, we'll deal with that.
Indeed, he seemed to be advising central banks to not to rush to raise interest rates, to allow inflation to rise maybe even beyond your target rate if necessary, because the trade-offs, he says, are so much better if you allow your economy to grow.
Well, we're in the situation now that the accommodative monetary policy in Europe is helping on both fronts. It's needed to get inflation back to target, but the same accommodative strategy is a considerable boost to European GDP. So we're not in a trade-off situation at the moment. Easy monetary conditions are needed for inflation reasons, but so happens that will also help so much of Europe is still far away from full employment to bring the recovery back. There are scenarios where that trade-off is more substantial, but we're not in that situation at the moment.
What do you think of the state of the global economy right now? As we start to see some global bond indexes invert. A Bank of America ICE index has inverted 2s, 10s,
Sure.
basically. And as we see these threats out of the U.S. of bigger and bigger tariffs on global trade, does the global economy look fragile to you?
Well, I think we have a mixed picture because remember also right now, this year and next year, the U.S. fiscal stimulus provides a big global impetus. If you think about over the last year, various emerging market economies have kind of returned to, with the recovery in oil prices. There's been, some solid platforms for short-term growth in the world economy. So what we said last week was there's a lot of positives in the world economy, but clearly the trade dimension is a risk factor. So if what we see now in terms of these disputes, if that became widespread and if it persisted as opposed to being a short tactical phase of negotiation, that would be a serious blow to the world economy. So I think right now, as of June, we have a balanced world economy. Those risk factors are there, but it's important not to forget there's baked in a big stimulus from the US economy. For oil producers, the rising oil prices is a positive for those parts of the world. So, I think the balanced picture is what we saw last week when we made the assessment. It is a balance of risks. But, of course, this trade issue, we have to keep a close eye on. And from the global point of view, resolving this, moving on with an open trading system is the best profile for the world economy.
But if we get these $200 billion tariffs on $200 billion in goods from China, and then China retaliates with something in kind, do you start to change your models and really get concerned about global growth?
Well, it's important to say those numbers, of course, are big, and they are really important for the sectors in the front line for that. But compared to the size of the world economy, they're still relatively contained. So there are other factors going on in the world economy. So I wouldn't say that in and of itself it's kind of sufficient to derail the world economy. But if it became much more widespread, if these relatively contained disputes became more widespread and they persisted, that we went into a world where people believe this is the new normal, that would be a big concern. But relatively limited tariffs in a select number of sectors is a matter of serious concern, but it's not macro relevant to a large degree unless it becomes a lot bigger and a lot more persistent.
Let's get back to Europe. We just heard Richard Nade speaking with Francine Lacroix about banking union and reform in the euro area. Only a year ago, I was talking to ECB officials who were sure we were going to have EDIS by now and much more progress on this issue than we have. How important is it for the European Union to pursue banking union?
So I think from my point of view, the first thing to say is a lot has happened. So compared to a few years ago, the fact we now have this single supervisory mechanism, we have the resolution mechanism, we have much better capitalised banks. We have much less concern about the fragmentation of the banking union. A lot has happened, but it's important to keep that momentum and to finalise it, to make sure we have the backstop for the resolution fund and to make progress with EDIS. I think most of the debate is not really about the concept of EDIS, it's the speed. And so long as the momentum is in the right direction, the debate about those who want to go more quickly and those who want to go more slowly is a genuine debate, but it's much less consequential than if we were having a serious debate about not to move forward at all. And I think most momentum is in the direction of moving forward. I think that the question is really about speed.
Don't you think that the rise of populist governments and concerns over migration have really done damage to willingness to share risk and make fiscal transfers?
So I think you're bringing together a lot of different issues. There's no doubt that major European-wide political issues such as migration are a major challenge for Europe, and finding common solutions to that is, I think, very important for the European Union. But I would not conflate risk sharing and the issue about fiscal transfers, because there's many ways to share risk in a way which doesn't imply permanent transfers. And I think that the technical discussions are far advanced. We know at a technical level about what kind of schemes would make collective sense for Europe. And I think we have to be proportionate in thinking about that. But it's in our collective interest to make the euro area stronger, to have a stronger institutional infrastructure. But what is true is there's no single answer, there's no single recipe there. And what we're seeing is a debate about variations on that. But the fundamental is, compared to a number of years ago, the euro area is a lot stronger from an institutional point of view. The nature of these debates has moved forward a lot compared to what might have been expected. But of course, a lot remains open and to be decided.
It just seems to me that the migration issues have led to the rise of these populist governments who have all got the same kind of Eurosceptic sentiments. You don't see that as a...
They are interconnected. I mean, of course, there is interconnection, but I mean, ultimately, we have to work within the frameworks. And for economic and financial policy, we have, over the last number of years, developed a framework with a lot of interlocking pieces. And so long as these debates about the appropriate policies for different countries remain within the framework of the treaties, within the framework of what is needed for banking union, for a stable monetary union, then of course politics remains. It remains, of course, part of the normal process. Elections happen all the time in different countries. Governments will have their priorities. So, so long as that is within the general framework of treaties that the member countries have agreed to, then that's to be expected.
Let's get to some Irish issues. I, of course, am Irish. I'm sure you can hear it in my voice. And I would love to buy a house there. Prices are rising at a faster pace than in almost any other region in Europe right now. Are you concerned about Irish house price inflation?
So I think it's important to put this in context. We are also an economy that's growing quite quickly. So employment is growing strongly, wages are picking up. So when we talk about house prices, there are some strong fundamentals there. It's also the case that we're still far below the peak prices, but of course any central bank is going to keep a close eye on the housing market. We have put in place credit measures, so there's a limit to the loan-to-value ratio, the loan-to-income ratio on mortgages. So we are putting, if you like, risk management parameters in place. So if there were any downturn in the future, there's cushions, there's buffers there in terms of down payments, in terms of limits on the amount of debt. So what we have now is a strong market, but we think over time as housing supply increases, some of this will cool off.
All right. Well, I appreciate your time this morning. Hopefully, I can take advantage if there is any downturn in the future. Philip Lane, Governor of the Central Bank of Ireland, joining us here in Sintra.